Is Polygon dead, or is this the single most asymmetric trade setup of 2026? We are looking at a chart that is frankly terrifying for most holders. We are sitting at 10 cents, hovering right on the edge of a cliff that drops straight down to 6 cents. That is a potential 37% drop from where we stand right now. But here's the twist that no one is talking about. While the price is bleeding out, the on-chain data is printing record highs. We are seeing payment volumes explode by over 1,000% and stablecoin usage that is leaving Solana and Base in the dust. The divergence between price and value has never been this wide. So, am I selling my bag and walking away? Absolutely not. In fact, I'm doing the exact opposite, but with a very specific, tight invalidation level. If we lose this support, the game changes. Today, I'm going to show you exactly where I'm buying, where my stop loss is, and why the Heikin Ashi RSI is flashing a signal we have not seen since the migration. Welcome back to the channel. I know for many of you holding POL, your position does not look very happy right now. We are staring at a weekly chart that has been brutal. We are trading around 10 to 11 cents, essentially at all-time lows. I want to be real with you guys. I have been in this ecosystem for a long time. I bought my first MATIC back in 2021 at 3 cents. I took profits all the way to $2, but I also reaccumulated heavily around 25 cents and 20 cents last year. So, looking at 10 cents today? It's painful. It's frustrating. I'm not going to sugarcoat it and tell you we are going to the moon tomorrow just to make you feel better. The sentiment out there is crushed. The crowd is bearish, and rightfully so. But successful trading is not about feelings. It is about execution. We have to separate the emotion of our long-term bags from the opportunity of a short-term trade. And right now, despite the ugly price action, there is a setup forming here that I cannot ignore. We are seeing a clash between a technical breakdown and a fundamental breakout. Most people are capitulating right when the metrics are starting to make sense. Let's look at why I'm even interested in this token when the chart looks like a falling knife. If you look at the fundamental layer, Polygon is quietly becoming exactly what they promised, the #1 chain for payments. Mark Boiron from Polygon Labs tweeted recently that in 2026, they are cementing their status as the top chain for payments. And this is not just marketing speak. Look at the data from Dune Analytics. In 2025, the monthly volume of payments apps on Polygon surpassed $1.27 billion. That is more than doubling year over year. We are talking about real utility here, not just meme coin speculation. And it is not just volume. Check out the stablecoin dominance. Polygon finished 2025 in the lead with 2.5 million monthly active addresses transacting USDC. That's higher than Solana at 2.1 million and significantly higher than Base at 1.8 million. In crypto, liquidity flows where stablecoins flow. Stablecoins are the lifeblood of this industry, and right now, they are flowing through Polygon. We also have to talk about the supply shock. Vadim posted some data showing that in just 3 days, the network burned a massive 1.8 million POL tokens. In November and December alone, network activity burned about 40% of all newly issued tokens. That is the highest level in history. So, we have rising demand, rising burn rates, and dominating stablecoin usage. Yet, the price is down 96% from the highs. This is the definition of a disconnect. The market is pricing Polygon as if the network is dying, but the on-chain activity says it is thriving. Usually, price eventually catches up to value. The question is, can the technicals hold long enough for that realization to happen?
Now, let's get into the charts, because this is where we make our money. I'm looking at the weekly chart.
We have been stuck in this descending channel since the local top of 75 cents back in December of 2024. It has been a slow, painful grind down. Recently, we lost the middle line of this channel, that dashed orange line you see on my screen. That mid-channel acted as support back in August, but we sliced right through it. Currently, we are sitting below the 1618 Fibonacci extension level, anchored from the swing high in September at 29 cents to the low in June at 16 cents. Now, we have been losing that 1618 level at 11 cents is technically very bearish. It puts us in price discovery to the downside. However, let's look at the indicators, because this is where my thesis for a bounce comes from. Look at the Heikin Ashi RSI at the bottom of the chart. We are in extreme oversold territory. This is a record low since the token migration in September 2024. The indicator is pointing strictly downward, showing significant momentum exhaustion. I have marked previous oversold instances with white circles on the indicator and green lines on the price action. Look what happened historically. In October 2024, an oversold signal led to a 160% rally. In April 2025, it led to an 80% move. In June 2025, another 80% move. Every time we have hit these depths on the Heikin Ashi RSI, we have seen a massive relief rally. We are currently deeper in the oversold zone than any of those previous times. Also, look at the volume profile on the left. We have a point of control way up at 24 cents. That acts as a magnet. If we can get any bullish momentum, price will want to revert to the mean, and that mean is over 100% higher than where we are now. So here's my strategy. I'm treating this as a specific trade setup, separate from my long-term holdings. I have established a load zone between 10 cents and 13 cents. That's the green box on the chart. I'm accumulating here for a short-term swing. The risk-to-reward ratio is incredible because my invalidation is so close. My stop loss is set strictly at 10 cents. If we get a weekly candle close below 10 cents, this trade setup is invalidated. I want to be clear about this. If the week closes at 9 cents, I'm cutting this short-term position. Why? Because if we lose 10 cents, the next technical support is the bottom of the descending channel and the 2618 Fibonacci extension. Both of those line up perfectly at 6 cents. That is a 37% drop from here. I'm not interested in riding a trade down another 40%. For my long-term bag that I have held for years, I'm not selling it here. It makes no sense to sell at the bottom. But I'm also not adding to that long-term stack if we break 10 cents. I'll wait for 6 cents to reaccumulate if that flush happens. But assuming this level holds, which I believe it has a good probability of doing given the oversold conditions, here are my targets. First take profit is at 16 cents. That is the previous support turned resistance. Second target is 20 cents, which is the 618 fib retracement. If we clear that, we look at 25 cents and potentially 42 cents in the longer term. I'm using a trailing stop strategy. If price hits 16 cents, I move my stop loss to my entry price. If it hits 20 cents, I move my stop loss to 16 cents. We lock in profits and protect capital. That's how you survive in a bear trend. To summarize the game plan, we are betting on a mean reversion play. We have extreme bearish sentiment paired with extreme oversold technicals. That's usually a recipe for a violent bounce. The upside to the first major resistance is about 60%. The downside risk to my stop loss is less than 10%. That is a 6-to-1 risk-reward ratio. As a trader, I'll take those odds every single day. However, you must respect the trend. The trend is down. The moving averages, the 10, 21, and 55 EMAs, are all above us pushing price down. We are swimming upstream. That's why the stop loss is non-negotiable. If we do close below 10 cents on the weekly time frame, my plan shifts immediately. I'll close the long trade, and I'll actually open a short hedge position targeting that 6-cent level. That is how you hedge a declining asset. You do not just sit there and hope, you trade the volatility. So here's the bottom line. Polygon is arguably the most utilized chain in crypto right now for real-world activity, yet it is trading like a ghost chain. I'm betting that this gap closes, but I'm keeping my finger on the eject button if the market decides to flush one last time.
I covered this thesis briefly in my Telegram group today, noting that the weekly close is the deciding factor. If you want those updates in real time, because things move fast and I cannot always make a video, make sure to join my free Telegram group. The link is in the pinned comment. And if you want to understand the bigger picture of where I think the market is going in 2026, or see my analysis on why I established these specific levels for Polygon back in December, check out these 2 videos on the screen right now. They will give you the context you need to navigate this year. Thank you so much for watching. Never financial advice, and I'll see you guys tomorrow in the next one.